Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 326th VideoCast podcast for the week ending January 15th, 2026. We got a lot of great stuff to cover this week, but as always, family first. There's my beautiful wife, Caitlin, and we got to go to the Lakers game due to our incredible new neighbor and friend, Ronnie W., for setting this up. We got the VIP treatment. That's the sign that they had for us in the restaurant area. This is with the great one, Wayne Gretzky. I grew up looking up to him my entire childhood. That's me doing Charles Payne live in studio in Los Angeles on Friday before the Lakers game. That was fun. That's me and Caitlin on the court. And I think that's it there. One more picture of Charles. Then here's us on the court. Thanks again to Ronnie. Super exciting. We had that's Caitlin and I on the court. What a game. This guy, Luka and LeBron, it's so funny to see him. He was loafing around for 3 quarters, and then when they brought the game, they were down 10. They got it caught up, and man, the champion comes out in that guy. He's an animal. They weren't able to fully pull it off, but they definitely made it an exciting game. There's Mimi and Annabelle, family first, super excited. Their friends were in. Parker and Xander and Cassie from Connecticut. They all got to go out to dinner together. Super exciting. That's on the floor of the New York Stock Exchange. That's in front of the New York Stock Exchange for the new people. Never gets old. More from the NYSE, more from LA. That's with Diane King Hall. Thanks for having me on there. And this is with the GOAT of roll-ups, Mr. Brad Jacobs. Invited me to his book party on Monday night, How to Make a Few More $1 Billion. If you'd invested $1 million with him in United Rentals, you made 200. If you did it with XPO, you made 50. And he lays out the roadmap. Pro tip: second book even better than the first. Read them both. What an amazing night. Got to talk to him about a few things that I'm working on. That was at Cipriani outside where they did it. That's with J.D. Durkin at the New York Stock Exchange. Thanks for having me on. That's Liz Clayman was the MC. So good to see her this week as well at Brad Jacobs' party. 700 of his closest friends. And then I went to do channel check at the Van store when I met with my buddy Blake for dinner. And the lady here are the K-pop Demon Hunter shoes. She said, we can't keep them on the shelves. We sold out every time we got new ones in. We had to turn away a lot of people. They were sold out on the website. So the good news is they keep selling out, and even now they keep selling out. The bad news is they didn't have enough to satisfy the demand. I don't know what to say about that, but I think that's a champagne problem, but it might be a management problem. Either way, it's good. That can be fixed. This is on the set of the Big Money Show. Again, the cameras, for those of you who are new, kind of see behind the scenes in front of the Fox building, and that's that. Then I got to join Charles Payne Friday from Los Angeles. By the way, the shadow, I'm wearing my Hedge Fund Tips hat, so you're going to just have to deal with the shadow. I'm psyched about this hat. We got some new pictures that people sent in. I want to thank Nick Palazzo and Charles Payne for having me on Friday, live in studio in LA. We're going to listen in here.
Well, my next guest is only looking for 7,300 for the S&P this year, but pay attention, folks, because he says that he's not bearish. In fact, that there will be many stocks up 50, even 100% this year. And by the way, they're not in the current top 10. So let's bring in now the Great Hill Capital Chairman, Thomas Hayes. I love hearing this, Tom. You know, listen, I'm a stock picker, always have been. I don't, quote unquote, play the market because I think individual opportunities, this is what you do also, right? Yeah. You focus on these things and you've got your own way of going about this. When you say this to people, though, you know, what do they do? Are more and more people even believing this is possible?
Well, they're seeing it happen in real time. We've been, pretty consistent. We've developed a reputation on the street for turnaround Tom. We buy things that are beaten down that can recover. Look, fortunes are going to be made in the stock market this year. They are not going to be made passively in indices. You're going to be underwhelmed if you are in indices or if you're overweight in the Mag 7, because midterm elections years, going back to 1950.
We've got a chart here to kind of talk about what you're talking about here, right? So we come out the gate usually okay, then we flatline, and then we usually have a nice rally into the end of the year.
Yeah, and the average returns of the NASDAQ since 1950 for a midterm election year, negative 0.5%. S&P 4.6, Dow 5.2.
How wild cards, though, to this scenario, like the Federal Reserve, a new Fed chair, maybe a more dovish Fed?
Yeah.
How could that change this a little bit?
I think that we have ample liquidity. Normally, you get an 18% drawdown mid-year of a midterm election year on average. I don't think we're going to see that this year. The risk, I think, is if they appoint Kevin Warsh. Kevin Warsh is a hawk in dove's clothing, okay? I think that could be the only variable that would lead us back to a 15%, 20% correction this year. I think if we go Waller, if we go the other Kevin, okay, we're going to be just fine.
Or maybe even if in the end Bessent decides to take the job. So let's just say we go one of these guys. You do think an accommodative Fed's good for cyclicals, dividend payers, which have been out of favor for a long time, and multinationals, in part because of the impact of the dollar?
Correct. Okay, so dividend payers have been out of favor. They're the most underweight since 2000, going back 25 years. That's a huge opportunity. Easing cycle. We are in an easing cycle right now. You have to buy dividend payers. That's where you're going to make money. People are getting pushed out of money markets. They're going to look for dividend payers, dividend growth. Multinationals, companies that get a huge amount of their revenues abroad, are getting a tailwind, an FX tailwind. And cyclicals, the economy is back. The economy is roaring. Real economy.
All right, let's talk about making money. Let's start with your first play. That's Dentsply. Explain quickly. I love the symbol is phenomenal. X-ray, but what do they do?
Dentsply Sirona. This is the #1 manufacturer of dental supplies and dental technologies. They've been around since 1899. It's a very cyclical business. The stock is down 83%.
How come you didn't get the job to take over for Warren Buffett? Because I mean, listen, you buy these names, you've had huge success, but you don't buy them as trades. You build positions in them because they're severely undervalued.
Well, listen, the other guy just left. Don't ask, don't get. I haven't sent in my application. Mr. Buffett, I'm open to a phone call. But listen, this thing is going to be a double or triple over the next few years. They are the leader in the industry. You get a 5.7% dividend while you wait. By the way, in a turnaround, you're worried about solvency. If they need cash, if they just cut the dividend, it's $120 million of extra free cash flow. Balance sheet's healthy. This thing is going to be a monster.
I got less than a minute to do your last two.
Yeah.
So let's do NOV, because in part you think it's a Venezuelan play as well.
Yeah, we gave this on the show exactly a year ago at $13. It's $17 today. Now you have the Venezuela tailwind. You also have the commitments of traders. Commercials are getting aggressively long oil. The surprise of this year is oil is going up. They're going to benefit as the largest onshore and offshore rig seller and repair company.
GXO Logistics, a Brad Jacobs company. By the way, I don't know if you started reading his next book, the next $1 billion.
I read the whole thing. I'm going to his book party on Monday night in New York.
Really?
Yeah.
Good stuff. Okay, maybe I'll go meet you there. Yeah. So new CEO, AI robotics, and of course we just talked about Jacobs here. What kind of buy hold is this in logistics? Okay. You know, again, it's not sexy, but it's there.
Peak of the cycle was 2022 with COVID. Trough of the cycle is 2024. They're recovering. New CEO Patrick Kelleher came from DHL US. Ran that, was an $18 billion business. The guy is unbelievable. They get 75% of their revenues abroad, so they got the FX tailwind. Blue skies in the U.S. This guy knows how to run the U.S. He's going to do it. I talked to him for an hour a couple of weeks ago on my podcast. He has got everything in place. This will be not a triple, probably a double over the next few years.
Sounds good to me.
Hey, thank you.
All right. Good. Happy New Year. I'll probably see you in New York.
All right. And we're back. Then we had the opportunity to go on Varney & Co. with Stuart Varney. Want to thank Garrett Collins for that. We're going to listen in here.
Thomas Hayes joining me this morning. All right, so let's get straight at it. Do you think the Powell investigation should be dropped?
From a market standpoint, I'd love for it to be dropped. But let's just assume Jay Powell was not the Fed chair. Let's say he was the head of the CBO, and he lied about $2.5 billion of taxpayer money. He lied about $600 million of excess costs. He lied about the luxury features of the new building. Under oath in Congress, and he was the head of the CBO. Should he be investigated if he was not the Fed chair?
The word lie is very, very strong when applied to the Fed chair. You think he lied about the renovation project?
I think he misled under oath. And I think that from a market standpoint, I wish it would just all go away. It's better for the markets if it goes away. But if we just separate his title from what actually happened in Congress, it's probably worthy of an investigation if he wasn't the Fed chair.
Do you support the political independence of the Federal Reserve?
100%.
There you go.
Yeah.
I think we've got an answer there. Stay with me, you lucky guy. We're in for the hour. Back to the markets, please. The Dow is still down 280-odd points. I think Goldman... Is Goldman no, it's the banks are not doing well this morning so far, I believe. We're down 280 on the Dow, down 15 on the Nasdaq. Tom's still with us here, covering the market for us. When the market is... I like this. When the market is up in the first 5 days of January, on average, the market goes up 14% in that year. Is that accurate?
Yeah, that's going back many, many decades. I think there's a caveat here, Stuart. However, we are in a midterm election year, and the average returns for the S&P are only 4.6%. So I'd kind of curb your enthusiasm, but we're off to a good start. Market tends to be strong through April in midterm election year. Earnings are good. GDP now is good. Policy is good. So I think somewhere in the middle there should be a reasonable expectation. The money's going to be made this year, Stu, under the surface. If you're passive in indexes, expect mid-single-digit returns. If you're picking stocks with the broadening of the market, there are going to be dozens upon dozens of stocks up 50 and 100% this year, just like there is every year.
Yeah, just like there is every year. Pick them right. Tom, stay there, please. Got more for you later. The Dow is now down 348 points, slipping it further south. S&P down 17, NASDAQ down 40 points. Lauren's looking at the movers. What about Google?
Keeps going up. It is firmly in the $4 trillion club. The new high today is 340. Bank of America says it's going to 370. I was at the NRF big retail show yesterday. Google's Gemini was being used by almost every merchant and every retailer there. Its chatbot is being used to talk to customers.
Now that stock's up.
Yeah.
Right. Okay, I'm sorry. We've got Microsoft on the screen and it's down $5.
Wow.
What's the story?
The reason, well, I don't know why Microsoft is down today, but Microsoft is saying they're going to pay the cost for their data centers. They don't want to put those bills onto consumers.
Help me out here. That's $5 down.
I'm sorry.
Wait, Tom, come on.
They came out with 5 points. They said your energy prices are not going to go up, even though we're going to use all the energy in your neighborhood. We're gonna not ask for tax breaks. We're going to create jobs. We're going to invest in AI education for the local people to get jobs. So they put that out to offset the concerns from the administration, and the market is saying, wait, you're going to pay more for energy, and so on and so forth. So it's down a little bit. It's fine.
It's a good PR move.
You're not helping me very much. Tom, what do you make of the energy market today with oil at 60?
I think the big surprise of the year is energy's going up. Hedge funds and large traders are shorting oil in the hole. Commercials are always early, always right. They've been buying it hand over fist. Energy's going higher. Energy stocks, energy servicer stocks, we've talked about National Oil Well Varco on the show, which we own, are going higher.
But it depends on geopolitics, doesn't it?
I think that's part of it, but I think there's a supply-demand imbalance. I think that the worst has been priced in. I think it's going to take a long time to get the Venezuela oil online. And I think demand is growing because the real economy is growing due to deregulation, due to the policies of this administration.
And gas has stopped going down.
And gas has stopped going down.
On the markets, we still have a ton of red ink. Dow's off 200, Nasdaq's down 100. Tom Hayes is with me. Oh, guess what? He's got a stock pick. It is QXO, which I've never heard of.
I've got 2 home building plays. This is a Brad Jacobs company. Brad Jacobs, if you invested $1 million in United Rentals when he started, you made $200 million. If you invested $1 million with him in XPO, you made $50 million. This is his newest play. We gave it on the network around $11 or $12. It's $25. It's going to double again over the next few years. We've got a 4 million house shortage. And this is a home building supply roll-up, starting with the roofing supply company Beacon Roofing. $800 billion industry. He's going to get 6%. This will be a $50 billion revenue company. You can bank on Brad Jacobs.
You picked up on my habit of gesticulating with your hands.
I learned from the best.
Banging on the table.
I learned from the best.
The next, you're like Stanley Black & Decker.
Another housing play. This has been around since 1843. They are a leader in tools. They had a little bit of problem during COVID. They overstocked. They've destocked. They've taken $2 billion of costs out of the business. Margins are back up to 33%. They're going to 35%. The last time they were at 35%, Stu, it earned $8 a share. It traded at $150. It's only at $80 and change right now. This will be a double over the next 3 to 5 years.
A bargain.
A bargain.
Right,
Let's
Tom.
go.
Thank you very much.
Love it.
The massive buildup of AI data.
And we're back. And then we were on with Diane King Hall on Schwab. Want to thank Maya Sealshill for that. Let's listen in here.
Welcome back to Morning Movers. I'm Dan King Hall coming to you live from the floor of the New York Stock Exchange. Joining me now to gauge expectations for markets in the year ahead and the role political turmoil could play. We want to welcome in our guest, Tom Hayes, Chairman and Managing Member of Great Hill Capital. Tom, it's always great to have you join us here at the big board. So we finished at records on Friday, but we're already coming off of that with some unexpected volatility, if you will, or wild card, if you will, with the focus on the Fed. But let's talk about overall your expectation for this year, and just does this initial wild card line up with kind of the expectations you had?
Yeah, you never know what the wild card's going to be, but midterm election years tend to be the worst of the four-year presidential cycle. So if you look going back to 1948, the NASDAQ tends to be up or down 0.5% on average in this second year. S&P tends to be up about 4.6% on average, and the Dow tends to be up 5.2%. So what that implies is if you are sitting in passive indices, aka overweight the Mag 7, you're going to be underwhelmed with your performance this year. On the flip side, if you are a stock picker outside those top 7 or 10 weights, fortunes are going to be made this year. There are going to be dozens upon dozens of stocks that are up 50% to 100% off of their lows, and people can make incredible amounts of money if they're willing to do the research.
Okay, where are those fortunes to be made?
Well, I think in an easing cycle, which we're in, you want to be in dividend payers because people are getting forced out of money markets, so they're going to look for the yield out on the risk curve. You want to look for cyclicals. And the sector that tends to outperform tremendously in midterm election years happens to be healthcare, which is up on average 9% in that second year of a presidential cycle, while the regular indices are more subdued. The other thing that I would pay close attention to is those companies that have a tremendous amount of their revenue from abroad, because we continue to be in a weakening dollar cycle, which happens every 8 years or so.
Yeah.
We're kind of in the middle of it right now, so we expect continued weakness in the dollar for the next couple of years. And those companies that have those revenues, as they're repatriated, you get an earnings tailwind. And we like those companies in that group as well.
It feels like a different conversation that we're having now compared to a year ago this time, where there's all the talk about American exceptionalism. So basically, to me, you're saying there's two scenarios. There's a scenario where, as you mentioned, you could be underwhelmed, where you won't have big returns this year.
Yeah.
And so I imagine that for people who are in that camp, or potentially in that camp, the best is here now.
Yeah, I think the other thing as it relates to the weak dollar, not only U.S. companies with international earnings, international companies, like you're seeing this morning, as a matter of fact, just off the Fed news, you look at the Chinese stocks like Alibaba, we've been in for a while and it's up a lot, but it continues to go. It's up 5 or 6% today. That theme is going to persist. International versus U.S., small caps versus large caps, value versus growth, kind of everything flipped up on its head from what people are used to seeing the last 3 years. And you've been with me many years. The last 3 years, I've been a raging bull. So for me to come out here and say curb your enthusiasm if you're just in indices this year, kind of tells you what you need to know.
Okay, but you say you are not bearish overall, though.
Not at all. I couldn't be more bullish. It's just picking the right stocks.
Okay, and so there are some stocks that you see as key to portfolios this year.
Yeah.
I was looking through them, and I don't know all of them. So let's go through some of the ones that are on your list. There's a ticker X-Ray.
Yes.
That's in the dental space. Tell us about this one.
This is a healthcare stock. It has, by the way, almost a 6% dividend yield. This is a turnaround Tom special. Stock's down 83%. It's got positive free cash flow. It's the #1 maker of dental supplies and technology. It's been around since 1899. You can get it at 7 times earnings. What are the catalysts? What's going to change? Well, this is a highly cyclical business. We are in the trough of the cycle. They've got a new CEO, Dan Scavia. He came from Globus Medical. He was at Globus Medical for 10 years, CFO, CCO, CEO. During that time period, the stock was up 4x, 300% return. He's come in, he's going to clean up the business, he's going to catch the cycle right. They've already taken the costs out, and free cash flow positive. If they need more cash flow, which is a critical thing in a turnaround situation, people get nervous about, they can cut the dividend, That would free up $120 million a year of free cash flow. So their balance sheet is fine. And I think you're going to see this thing double to triple over the next 3 to 5 years. We love this stock.
Okay, you love the stock, but you mentioned obviously who you love, and that's kind of crucial to the story. Is there a key man risk factor there that you have to think about?
Well, he just started. So he started in August. He's just barely found the coffee machine. He's not going anywhere for the next 2 years, and the stock's already starting to go. This is our newest position in the portfolio. We started in December. Our basis is 1137. It started to move, but there's plenty of runway in this.
Okay, so 3 to 5 years is your look through on that one. And then you like GXO.
Unless it gets to 52 soon, then it'll be shorter.
Okay. There are ways you can make adjustments. GXO Logistics, what is the story there?
This is a Brad Jacobs company, another turnaround story. The key catalyst is Patrick Kelleher, came from DHL US, which was an $18 billion business. He's the best in class. New CEO. They get 75% of their revenues abroad, but he specialized in North America. So they have blue skies in North America in the defense verticals and the healthcare verticals. So he's going to grow the U.S. business. They got the integration of the Wincanton acquisition. That's going to add cost synergies and add more earnings to the bottom line. This won't be a triple or quadruple. This will be a double over 3 to 5 years, but we love the warehousing, logistics business, order fulfillment, reverse logistics. This is a high quality business. It peaked in 2022 when everyone was ordering things from home. It troughed in 2024. It's on the come. Margins are increasing, revenues are increasing, every free cash flow is increasing, return on invested capital is increasing. Everything you want to see in a turnaround story, Patrick Kelleher is the guy.
Okay, all right. So, and you mentioned obviously the attachment to Brad Jacobs as well. Is there another one on your list this year, or is there one that you're kind of tapering off your position in?
Tapering off. Well, we just got out of Albemarle because that was a triple much faster than we expected. We thought that was going to take 3 to 5 years. It took 10 months. So that was another stock that was down 80%. You couldn't give it away. Huge operating leverage like the ones that I'm sharing with you right now. So we're out of that. We took profits. We still think it's going to go higher, but at a much slower pace than it did. It was just happened too quickly, which is a great thing. That's a champagne problem is what we call them.
It's champagne problem. And I want to go back to where our conversation started. We were talking about the Fed. There's, some worries right now about the Fed's independence with these subpoenas hitting the Federal Reserve. At the same time, the question is who's going to be the next Fed chair. Hassett seems to be leading the list, but Warsh is up there as well. And you say there's some risk that may be underestimated with Warsh?
Yeah, look, Warsh is, he's a hawk in dove's clothing. I mean, the guy's been hawkish his entire career. He has a track record, proven definable, always hawkish. Now he wants a job. He's Mr. Dove. So I think that's a risk. I think that's the risk that we had with Powell. Powell came in, seemed like a flexible guy. The minute he got the job, he was pretty aggressive. You remember December 2018, he crashed the market 20%. So I think you want someone that's has more market savvy, more market feel, less kind of academic or parochial in their views. I think Hassett's the right guy. I think Waller would be a good choice. I think Warsh would probably, in the short term, upset the market a little bit. Maybe decent for the bond market. The bond market might feel comfortable because he's independent, but the equity market would be uncomfortable because they know his history. So I think that's a risk, but generally you're going to get some volatility this year. On average, in the midterm years, you get an 18% drawdown. I don't think we're going to get that just because GDP now, just because of earnings, just because of the economic policies and the deregulation have been constructive. But you get someone like Warsh, maybe you do get that normalized pullback this type of year. So we'll see what happens. All right. Yeah.
That's a good place to put a pin in our conversation. That's Tom Hayes, Chairman and Managing Member of Great Hill Capital. Our thanks to Tom.
To this great conversation. And we're back. And then we joined the Big Money Show, just like Varney, for the full hour as company. Charles Payne was also a guest on that, so that was a special treat. We'll listen in here.
Welcome to the Big Money Show. I'm Taylor Riggs, along with my co-host, Dagan McDowell, Brian Brenberg, Jackie DeAngelis, and with us for the hour, Great Hill Capital Chairman Thomas Hayes.
Great to see you.
Great to be here. Thanks.
All right, so no Supreme Court ruling on tariffs today, but that ruling still looms large, and President Trump standing firm, touting them as a key pillar to Trumponomics. Trump also saying Americans will start to feel the big economic boom from tax relief, trillions of dollars in new investments, partnerships on rare earths and AI, and record foreign military sales. So while the Supreme Court ruling could come any day now, Republicans are hoping that the verdict from voters is already in. All right, Thomas, what do you say?
Well, hedge funds have been buying the claims on the refunds for 30 cents on the dollar, so that tells me the odds are low that it will be overturned, but nothing, otherwise there wouldn't be a sale.
And claims on the refunds from the
companies that have been charged with tariffs, if they get refunds, that asset is worth 30 cents in the market right now. So hedge funds are buyers of that. So if they're right, if it does get overturned and they get the refunds, that 30 cents becomes $1. So I think it's low. You know, the key thing here is it's actually working. There were so many skeptics. Our deficits are the lowest in 3 years. That's why bond yields are subdued. And this is something you don't really want to see overturned. If it is overturned, there are 4 sections in the code that President Trump is going to use to achieve the same ends. 338, 332, 310, and 122 for the lawyers out there. I don't know what's in those 4 codes, but I do know he can use them to get the same effective result. The other thing that we'll see if it is overturned is a dividend check out to people, which is going to help consumer discretionary, et cetera. But what we have seen is a real incentive, an offer that businesses can't refuse to invest here in the United States. And that's consistent with what we're seeing in the broadening of the rally, cyclicals, manufacturing companies, real economy, real wages are improving because of this policy. Why would SCOTUS want to screw that up? We're going to find out in coming days, and hopefully they don't. And, you know, he's shown a little bit of moderation. The receipts were down about $3 billion in November and December because he backed up on a few different items, which has been positive. But, you know, the big story in the room, Intel today, there was an article, they have the opportunity now to become the second largest manufacturer of chips, surpassing Samsung because of that investment in the U.S. in domestic production and that vote of confidence from the government. So a lot of manufacturing directly and indirectly is happening as a result of this.
Vote of confidence, but you mean 10% stake in the company?
Well, they were given...
That's one way to vote confidence.
They were giving them the money anyway. They said, we want the taxpayer to get something. And now the taxpayer is up, by the way.
80?
No, more. You know, almost double already.
Definitely
Really?
double. We
Yeah.
were talking about Intel.
It was a $19 stock. It's $48 today.
When it was a dog.
Okay, so
Take some money off the table. You want to send checks to the American people.
quickly, I want your quick thoughts on this, Thomas. Bitcoin earlier at an 8-week high, 97, 98,000. Crypto-related stocks also jumping this morning. Is this risk on? Is this dollar debasement trade? What do you think?
A little bit of both. I mean, you know, anyone that comes on with a serious face and tries to explain why Bitcoin's going up or down, I take with a grain of salt. It's a non-productive asset. But there's a place for it in many people's portfolios, and I think it's a sign that people are willing to take a little bit of risk here. It takes the risk of the micro strategies of the world blowing up and having a credit event, so it's kind of showing some stability in the market. You know, gold is up, but this weaker dollar trend is just beginning. It's going to be a theme over the next 24 months. We're positioned for it by being in companies that get a lot of their revenues abroad, and because you get the FX tailwind, we're positioned for it. International will continue to outperform the U.S. like it did last year in terms of that. Not because of any policies good or bad. It's just the normal cyclical trends. To Brian's point, I think the economy continues to boom. We get the payoff for the money in the bank, but I think a lot of that's priced into market at this, and we're expecting more subdued returns for the indices, which are big tech weighted, and real opportunities under the surface for the real economy companies, industrials, manufacturers, cyclicals, et cetera.
Love the roundup. Dagan, wanted to jump in and go cross asset. Wondering if anyone else on the panel, maybe Thomas, you get nervous about this. Metals and food commodities could represent anywhere from 4 to 13% of CPI, 5 to 20% of PPI. And those core good prices were up 3.2% year over year. That's before the 5% increase that we've seen in the raw materials commodities index. We've talked also about gold, silver at records. Are we worried that deflation may not come because of all the massive raw commodity increases that we've seen? That's perhaps my worry.
Yeah, I think the big surprise of this year is that energy is going to be up. You see hedge funds and large traders are shorting energy in the hole like nobody's business if you look at the commitments of traders reports. And commercials have been buying it like it's going out of style, record buying. They're always early. They're always right. That's a risk in terms of input costs. The weakening dollar theme is going to persist for the next 12 to 24 months. It's a normal part of the cycle. So, yeah, that's a risk. But when I look at the map and I see big tech more subdued and I see 60% of the market green, it leads me into the theme that I've been talking about. This is a year where tremendous amount of money is going to be made in the real economy. I think the indices are going to be subdued because the big weights that Charles referenced are going to be consolidating a lot of gains and kind of churning through. Some will do better than others like we saw last year. 5 out of the 7 Mag 7 underperformed the S&P 500 last year. I wouldn't be surprised to see a similar result this year. But there are going to be dozens upon dozens of stocks under the surface, real economy stocks that are up 50 and 100%, and people are going to make a lot of money. You're seeing it today. Healthcare is up. You couldn't give healthcare away for the last 3 years.
Why would energy be a surprise? It was one of the worst performing sectors in the S&P 500 last year. It was the second worst next to real estate. And when oil gets down to 50-ish, and there's still demand, if you believe the economy is growing at 5% plus, as Jackie was talking about on Fox this morning, and then you have these bubbling trouble spots around the world. And bubbling, I don't mean to dismiss what's happening in Iran and Venezuela, but of course you go long oil, Charles.
Well, the risk reward is on your side, to your point. There's very little downside for sure, and because of the nature of it, it gets too cheap, demand gets too high, demand breaks down. So from a risk reward point of view, it looks like if you want to be long these energy players and get those big fat dividends of an ExxonMobil or Chevron,
right,
go for it. Go ahead.
I think to answer your question, Dagan, this is the lowest weighting of energy in the S&P 500 sector weight since 2000, which was the COVID lows when energy went negative. That was a generational buy opportunity. We were buying ExxonMobil at $33 hand over fist back then. And prior to that was the year 2000. You have to go back 20 years before that. And if you had built a position in selective energy names during those two generational buy opportunities, you made fortunes. I think we're set up on a similar one. I'm less sanguine on the integrated oil servicers. I think they're going to do okay. I think the servicing companies like the National Oil Well Varcos, which we own, onshore and offshore drilling rigs, sales and servicing, the Schlumbergers, the higher quality in that group, are going to do a lot better because they're less sensitive to the price. But the amount of volume that's going to be happening as we get Venezuela back online, as we do more domestic drilling, as the policies are more favorable, there's huge opportunity there. So maybe less Mag 7, more real world economy, U.S. domestic production.
When you have markets down 1 and 1.5% on the S&P and the NASDAQ, is it trading on Iran? No. But when you have the VIX up to 17, 18, when you've Brent back up to 66, 67, just wondering if we're starting to see a little bit of nervousness, and I punt to you.
I think so. I think Marco Rubio put it best when he quoted Biggie Smalls, if you don't know, now you know. Well, taunting President Trump at this time is not the right move, and it's going to lead to him probably going in and getting the job done, in which case you're going to see a spike in oil in the short term. But the U.S. oil companies have said we stand ready to go in and stabilize the situation. I think it will be a short-term situation, but certainly taunting the president with that type of article that you quoted from the Post is not the way to go. So I think any dip that comes as a result of this is probably a buying opportunity selectively, but we could see a little volatility if that does effectuate.
Yep. Give Maduro a call. Ask him how it's going.
Yeah.
Coming up.
It seems not. You know, when you think about crime and everything that's happening on the ground here, that has a huge financial impact for us.
Yeah, I think they're talking because they have a common interest in housing, actually, Trump and Mamdani. They want to do housing reforms. We've got an 800,000 unit shortage in New York City. And what they want to do is roll back some of the environmental rules that will actually increase the pace at which they can build and lower the cost by 11 to 16%. So I would bet that's where their common ground is in terms of Mamdani talking about affordability beyond free bus passes and free subway passes and everything else he promised, but actually putting people in houses, and you have to do that in a practical way, and that's something that Trump can be helpful with. As long as Tisch stays in charge of the police, I think we're going to be okay. I think we're going to be safe. That's a key tell. I'm sure President Trump has had some talks with him about that. Okay. And beyond that, he's going to appoint some of those people around him because that's just what they do, and it always has the victim narrative, and that's what they thrive on.
I got to pivot here. All right, Thomas, we want to thank you for being with us. Always great to see you. We've got Larry Kudlow up on deck.
And we're back. Really want to thank Madison Murtaugh and obviously Brian Brenberg, Jackie DeAngelis, Taylor Riggs, and Dagan McDowell for having me on for the hour. And then finally, JD Durkin over at NYSE Live. Want to thank Mel Montanez for that. We'll listen in here.
For their quarterly figures. The great Tom Hayes joins me now here in studio. Tom, a friend of ours here at the Exchange, chairman and managing member at Great Hill Capital. All right, Tom, well, we had expectations this week would bring one set of storylines, and then last night we got a lot more. Federal prosecutors are said to have opened an investigation into Jerome Powell. Your reaction?
From a market standpoint, I'm not terribly happy, but if you back out and you say, look, number one, $2.5 billion of taxpayers' money, $600 million over budget. They have some luxury features on this that maybe they don't need. He lied about it under oath. Okay, that's not an allegation that actually happened. So if he wasn't Fed chairman, should we let it slide? Can you just lie under oath and it's okay? The problem is he is Fed chair, so it does appear political, which makes the market unhappy. You see a dollar low, you see indices lower. So we'll see how it resolves. But on balance, the market's not going to like it until we get a little bit more clarity.
There's so much of this we don't know. Has your expectation even before this weekend been Powell would stay on for a different role at the Fed, which he still is able to do after his chairmanship ends?
My expectation was that he was going to go off into the sunset quietly. This might provoke him, assuming that he's not charged, which we don't know yet. To stay on a lot longer as kind of retribution for their political persecution, I guess, or the perceived political persecution. That's the way it's being framed. Again, if he wasn't Fed chair and he lied about $600 million of your and my taxpayer money, should he get away with it? And the answer is most people would say probably not. We should at least have a trial and find out what happened, what was true, what wasn't true. But in the meantime, markets are shoot first, ask questions later.
It is a midterm election year. What do we typically see in the 4-year cycle for equities when this happens?
All right. On balance, subdued returns. And you've known me for a while. I've been a raging bull for 3 years. We have more modest expectations. Since 1948, the average return for the NASDAQ in a midterm election year is negative 0.5%, S&P 4.6%, Dow 5.2%. Year tends to start off okay. The market should hold up through April. Then you get the real weakness into the election from kind of May through the election and finish out strong. But I think for many people who are overweight passive indices, which is AKA the Mag 7 and the top 10 weights, they are going to be underwhelmed with their performance, and they need to buckle up buttercup. They're going to see a little volatility this year. I think for those who are a little bit more adventurous and do work on individual stocks, the remaining 493, unmagnificent 497, I think fortunes are going to be made under the surface. I think there are going to be dozens upon dozens of stocks that are up 50 and 100% this year, and they're not going to move the needle on the index because their weightings in the S&P are so small.
So we do have an easing cycle. We have a weaker dollar. That's the backdrop. What are some of those sectors, those areas, those names that you do like in that environment?
Yeah, in this environment, you want to be in dividend payers. These are the most out of favor in 25 years since the year 2000. You want to be in those companies that have a lot of revenues and earnings offshore, okay? That when they repatriate, you get an FX tailwind for earnings. You want to be in cyclicals, real economy type of companies. And I think that's kind of where you'd be focused. Small cap versus large cap, international versus US. That weak dollar story helps international stocks. You're seeing this morning, the China stock, U.S. stocks are down on Powell. Chinese stocks are up 5-6%. Alibaba has been a big position of ours. It's gone up a lot. It's going up more. So the weak dollar is going to be the theme for the next couple of years, and that's how you benefit from it.
Tom, you got a year-end target of 7,300 relative to Friday's close. That's only 4.8% from where we are. How do we get there, and why do we only get there?
Yeah, I mean, you look at earnings growth is supposed to be 14%. GDP now is 5%. Why so glum, Tom? You've been a raging bull for 3 years. And the answer to the question is there are going to be surprises. There's going to be uncertainty going into the election. A lot of it's pulled forward with a 22 times multiple. If you think just about kind of rationalization of the multiple down to 21 or down to 20 times. And the biggest component of those earnings, Mag 7, the earnings growth is dramatically decelerating. So from 33% a year ago down to 14%. So that's going to take some juice out of the indices, so to speak, which are overweighted in those names.
The Poly Market odds-on favorite to replace Jerome Powell, former Fed Governor Kevin Warsh. Is there a bit of a mismatch between his history of commentary and maybe how dovish the perception of him is, given that the expectation is he is on the short list for the president?
Look, anyone that has a memory longer than 5 minutes knows this is a hawk in dove's clothing, okay? So this could be the surprise or the black swan, so to speak, that causes some mid-year volatility if he's selected as the Fed chair. I think that the bond market might like it because of his independence. I think the equity market's not going to like it because the equity market has a longer memory that this guy is a hawk.
How about Hassett or any other wild card candidate?
Anyone else is great. It doesn't matter. Anyone other than Warsh. I would say Hassett's great. Waller would be great. Bowman would be great. They're all kind of more moderate in their thinking, and their history supports that. They're not just saying what they need to say to get the job.
Why is right now a generational opportunity, as you say, to buy energy? What do you like for your energy names?
Look, commitments of traders, commercials right now are aggressively long WTI. They're always early and they're always right. We like the servicers, National Oil, Well, Varco, NOV. They've got $1 billion of cash, $1 billion of free cash flow. They're the leader in onshore and offshore drilling rigs, sales and service. They're going to be a big Venezuela beneficiary as well. This is a name we like.
Why so glum, Tom? No, I'm kidding. Not glum at all. The great Tom Hayes, chairman, managing member at Great Hill Capital. Come back anytime. Great to see you.
Thanks, JD.
Folks, coming up.
And we're back. On to the quotes of the week. We enjoy the process far more than the proceeds, Warren Buffett. And that's the secret to proceeds, ladies and gentlemen. The minute you find something you love to do and put in the time and get the experience, you never work another day. And as a result of providing all that value, you have more than you could ever imagine. Tepper. I think when it comes to decisions, I try not to be emotional, to drown out the noise and look at the important facts. That's what we teach here on a weekly basis. Want to thank all of our supporters. We always say, whether you can quite a few of our clients couldn't afford to be clients, and they listened to the podcast for a week or two. Excuse me, not a week or two, a year or two, made some money, and then they met the hurdle and they were able to become clients. But not all of you will become clients. And if you're getting tremendous value, which I know so many of you are from all the beautiful emails and testimonials, making a lot of money in your accounts. The best way you can give back if you can't become a client is to share the podcast with one person you care about each week that would benefit from this information and making money the way that you are. And an easy way to do that is to get the hats or the mugs or the t-shirts, and people will ask you and you can tell them all about it. And so many of you have become part of the community and not just bought a hat and all that. And we're grateful for that, but I think we make $4 or $5 on the hats. It's not really what we're here to do. It's for you to wear them out like Daniel F., Jeff B., and Tyler C., who sent this awesome picture of the three of them wearing the hoodies this week. I mean, if you don't get questions on that, you're just not looking at anyone in the eyes, that's for sure. And then Paula and Nancy Hauk sent this awesome couple shirt. He's wearing the T-shirt, she's got the mug, and on and on and on. And then you get to be familiar with some of the folks in our community, and we're going to just keep building out this page. So, look, hundreds of you have ordered this stuff, and dozens of you have sent in pictures. So the hundreds of you have ordered. A, we're grateful. B, keep sharing the podcast. And C, send in a picture. If you don't want your last name, we'll just put your last initial. If you do want your last name, we'll put your last name. And we could always change it. We could always remove it. But share, get out there, give back, and we'll keep this thing humming along for you guys to make money for years to come. All right. On to the data. Intel wins the top CES 2026 award for the Panther Lake processor. Seems like 2026 could be the year of Intel across all fronts. Intel could become the number 2 chip foundry. Analyst says they're going to beat out Samsung. That's from John Vin over at KeyBank. Put a $60 price target. Their CPUs for data centers are selling out. They've had to raise the price by 10 to 15% because they can't even fulfill demand. Super exciting stuff that we're seeing. Analyst comments, we expect outsized data center demand from hyperscalers this year to be a significant tailwind for data center and AI. Our checks indicate Intel is almost sold out for the year in server CPU, and given the strength in demand, the company is considering a 10 to 15% ASP increase. We are seeing significant progress being made on the foundry front, with 18A yields improving to over 60% and good enough to ramp Panther Lake, while not best in class as TSMC was at 70 to 80% when they launched 2 nanometer. With Intel's aspirations of being the number 2 foundry supplier, 60% plus yield is significantly better than SF2 at the Samsung foundry, which we believe is less than 40%. Our checks indicate Intel Foundry Services has landed Apple as a customer on the 18A for low-end M-series processors for MacBooks and iPads, which is expected to go into production in 2027. Additionally, we believe Intel is in discussions with Apple to use 14A to support low-end mobile A-series processors for iPhones in 2029. Ladies and gentlemen, you couldn't give it away at 19 when we were pounding the table on Varney & Co. Now at 48, everyone wants it. The legacy business is priced in here. Now you're making a bet on the advanced chip production and the foundries and Lip Bu Tan, who had a 68 bagger in his turnaround at Cadence Design Systems. Moving along, Trump tweeted, or whatever his thing is called, I just finished a great meeting with the very successful Intel CEO, Lip Bu Tan, launched their sub-2 nanometer CPU processor designed, built, and packaged right here in the USA. U.S. government is proud to be a shareholder of Intel and has already made, through its USA ownership, tens of billions of dollars for the American people in just 4 months. We made a great deal, and so did Intel. Our country is determined to bring leading-edge chip manufacturing back to America, and that's exactly what's happening. Citi upgrades Intel to neutral after it's up double and a half already. So they're just getting with the program. Dent Sply, Sirona, our newest position, is starting to get some interest. They'll get super interested at $30. They weren't interested at $11. They're more interested at $12.50, and they will be super interested at $50. That I can guarantee you, and we will help them out with all the shares that they want. So they're renewing their partnerships with Patterson and Benco, and the new CEO's fixing that from Globus Medical. He had a 4-bagger there over his 10 years. The stock return to growth action plan is working, etc. Let's go to the Slumer tapes. We've got some longer range charts here. S&P consolidating a little bit of its gains and now starting to move higher up against this resistance. We break through 7, we're going to move higher for sure. We're not overbought on this indicator here from Slumer. Staples, look at Staples, ladies and gentlemen. Rock and roll, lock and load. We are positioned and benefiting from this trend. No one believed it in December. Everyone's believing it now. Oil servicers, rocking and rolling. National Oil, well, Varco, you couldn't give away oil last year. Now everyone is getting interested. NASDAQ, Golden Dragon, China Technology Index, just getting started, lady. Yes, I know Baba's flying, but it's going to fly a lot more over time. And that's that. Back to data. Just in, the experts are furious after Ford plant in Michigan moves to 24 hours a day, 6 days a week because the economy is booming. They've never seen what's happening now. This plant goes 24 hours round the clock. They're adding a third shift. Guess who benefits? Cooper effing Standard, ladies and gentlemen. We're super excited about that. Those of you who are with us in 2022, you own your shares at $5. Now it's 32 and going a lot higher. Mag 7 versus the S&P 500 rolling over. Who was calling for that? We were calling for that. You're all positioned for that, and you're winning. As mortgage rates fall below 6% for the first time since 2023. Okay, I was 13 days late, ladies and gentlemen. This was January 13th. I said it was going to happen by the end of the last year. It took another 13 days. Here's the number one mortgage lender of January 2026. Alibaba's Quen family hits 700 million downloads to lead global open source AI adoption. PayPal powers Microsoft's launch of Copilot checkout. We were in the market today buying as much as we could get our hands on. Thank you so much, you nervous Nellies. We love you. We love you just like we loved you selling us Baba at $58 and $59, and our fingers were bleeding buying shares back then. Same thing with PayPal. Amen. Hallelujah. Praise the Lord. We are excited. S&P 500 positioning indicator starting to move more along. Average 12-month change in S&P 500 PE since 1980. This is based on the Fed funds rate and all that stuff. Jim Paulson. First time on any one-year trailing period, Russell 2000 index has outpaced the S&P 500 since October 2022. This bull market is changing its stripes. Amen, hallelujah. We've been talking about this till the cows come home. Small better than large, international better than US, cyclicals better than tech, and buy your dividend payers in an easing cycle. People looking for dividend yield, they're getting forced out of money markets back into the game. Hallelujah, Hormel. China net exposure near 5-year troughs. U.S. hedge funds still underweight. We love when those idiots are selling in the hole because they are going to get forced in and squeezed like nobody's business. Amen. Here we go. On to the next. GDP now at 5+%. They say Trump wants to run this thing hot. He wants to run it like a blowtorch. The real economy is booming and is going to continue to boom for the next few years. Be positioned accordingly. That means cyclicals. That means companies making real stuff. That means the Great Hill Capital portfolio. How you doing? All right, US dollar. When I keep saying this trend is going to persist for a few years, it's exactly what's going to be happening. When we were talking like this in 2024, everyone thought we were crazy. It's just beginning, ladies and gentlemen. And you position for that with international. You position it for that with multinationals that get a lot of their revenues abroad, like the dense supply Saronas, like the GXO Logistics, etc. Boeing airplanes delivery starting to cook. That stock is flying, man. You couldn't give it away last year at 135. Now everyone wants it at 250. It's going to 300. We're super excited on that one. Russell 2000 median stock earnings growth. Small caps going to be 55% this year. Large caps, S&P 14%. And by the way, the relative PE ratio of small caps to large caps hasn't been this low since 2000, over 25 years ago. If you had bought small caps when it was this low on a relative basis, 0.77 times the multiple of large caps, the next 7 years, you dramatically outperform the index by having small cap exposure, which we have across the board, whether Cooper Standard, whether Comstock Resources, whether Canada Goose is loose, whether Dentsply Sirona is almost a small cap, etc. We've got our exposure. We are excited. Global monetary policy stimulus just kicking off. There's abundant liquidity, 330 cuts last year, the most since the great financial crisis and since COVID. That's going to support things along the way through this rotation, even if indices are subdued due to the underperformance of Mag 7, like we saw last year. Five of the 7 Mag 7 underperformed the S&P 500. If you were on Great Hill. If you were on Hedge Fund Tips with Tom Hayes in late 2024, you expected that and you were positioned for it and you won big time. Emerging markets relative versus developed markets. This is the catch-up trade. You haven't had this beautiful of a situation since 2000 and before that since 1986. And if you got emerging markets exposure, you made bank, and that's going to be the case for the next 5 to 7 years during the weak dollar trend. And you're going to play that through Ali, F, and Baba, which you're already up a lot on, and Baidu, and some of the others that we've been talking about over the last couple of years. Housing affordability at its highest level since 2022. This trend is just starting. Your home building basket is going to rip. QXO is already up more than double from where we talked about it. Stanley Black & Decker's making the move, baby. It's on the fly. Generac is going to be a monster beneficiary, so we're rocking and rolling. All right, cumulative growth. All right, that's that. Goldman clients near most bearish on oil in 10 years. Amen, hallelujah. That gave us the opportunity to get into National Oil Well Varco at $12 and $13. That's just beginning that trade. Now it's 17 going to probably 40 or 50 over the next few years. So we're excited about that. Please keep shorting in the hole. We will be happy to help you out. Give us a chance to buy even more shares. How you doing? Moving on to the next thing. Full year returns when the S&P's up the first 5 days of the year, average 14.3. So that kind of offsets the bearish kind of outlook of a midterm election year. Again, we're calling for mid-single digits for the indices. Tons of money for under the surface for people who have a proper framework and know how to buy great companies at good prices. Small cap to large cap historic PE ratio. This is the chart that I was talking about. Now you can see it visually. You bought small caps here. You made bank for the next 7 to 8 years, dramatically outperforming the S&P 500. Mortgage payments are coming down. 2025 saw less dominance from the Mag 7 understatement of the year. Here's a healthcare sector equal weight ETF. You can see here breaking out of its cup and handle, which implies a gain of about 70 to 80% here over the next year. That's why we have so much healthcare exposure right now, which we couldn't be more excited about between Pfizer, Baxter, and Dentsply Sirona. My Sirona. Biotech, we already rode that baby. We had to hit the window, not because it's not going higher, but because the IRR prospectively is much better for Dentsply Sirona. We're excited about that one. Moving along. Disney theme parks and other capital investments. We love high return on capital investments and allocations from management. That's exactly what they're doing at Disney between the parks and the cruises. We went a week or so ago. The place was sold out, by the way. Fortunately, my wife does a good job of planning all that stuff, or we would not have been able to get in at the park. Kind of like the K-pop Demon Hunter Vans sneakers. So we like to see that in our portfolio company. Average interest rate, 30-year mortgage, the lowest since January 2023. You heard it here first. I told you they had tools. So now they're buying $200 billion of mortgage-backed securities out of the FHA, bringing it down that way. Sooner or later, Bessent will start playing with the yield curve and buying in on the long end, and you'll see further compression. And one way or another, they're going to get a dove into the Fed, who is going to continue the easing cycle, probably another couple cuts this year. CapEx revised higher. All that's the onshoring that benefits our type of companies. Turnovers hitting a record in China, so that's good. M&A loan volume jumps. Animal spirits are back. Manufacturing capacity is picking up after 10 years of underinvestment in the United States. We love to see that. Those are high-paying jobs. That helps consumer discretionary and cyclicals. Housing inventory estimate, okay, still low, still a lot of opportunity there, still a lot of runway. Households owners equity in real estate is very, very high. Again, I'm sticking with my thesis that as rates go down, prices will go down, which is the opposite of everything that everyone is certain about, that when rates go down and prices are going to go up. I think you're going to see a glut of supply hit the market all at once. And it's just like the stock market. It's like once you see the mark to market of your neighbor's house 10% below market, you panic and you hit the window. And considering most of the people with the inventory are in their 70s and 80s and want to maximize their cash out, they will get fear of loss, the opposite of FOMO, and they'll all list at once, which will put further pressure on the market. I think that you're already seeing it in Florida and Texas, and that's where it starts every single cycle. I know out here in Orange County, and my buddies are going to completely rip on me this week, houses never go down, except that they do. In the early 90s, they went down a lot, but most of us are too young to remember that. And it will be an interesting awakening. Despite the beautiful, perfect weather and sunshine, prices can and do go down, certainly around the country, and I believe in Orange County as well. So rip away. Look, I'm a stock picker, so take my real estate advice with a grain of salt. But I think over the next 18 months, you guys are going to do fine. So positioning in mega cap growth and tech has been drifting lower. Consumer China confidence is ticking back up. That's good for BABA, the toll taker. Sentiment is now moving to the Mag 493. We were ahead of the curve on that. It took them a year of seeing that before they started to believe it, and they still don't fully believe it, and they're going to miss it again. Earnings drove the majority of S&P returns in 2025, 2026. What else do we have here? A little bit overbought on the S&P 500, which implies tech. And risk appetite indicators getting a little bit frothy there in the short term, which means we get a little bit of gut punch in the indices. The defensives will get bid, which is what we want to see, and we are seeing already. Here's the seasonality. We've been talking about this midterm when seasonality meets policy change. As I've stated on my media appearances, the market should hold up through April. You get a lot of weakness into the election, generally in midterm election years, and then you finish out okay, usually mid-single digits, 4.6% average for the S&P. Fortunes made on individual stocks. If you're positioned right with healthcare and defensives, healthcare outperforms by 9% in midterm election years. So we just love this type of environment. We do. We had an unbelievable year last year, and the year before, but we tend to do really well when everyone does poorly. Because we have such a low correlation to the S&P, because we're private equity in the public markets. We're buying discrete businesses. If we wouldn't buy the whole company with 100% of our net worth, we won't buy even one share. So I'm super excited about this type of environment. Global commodity stocks versus oil and gas. Natural gas prices doing well. Comstock, we love you. Small caps outperform larger rivals 9 days in a row. Oh yeah, okay. Get used to that. Going to be a lot more than 9 days in a row. Equal weight starting to outperform cap weight. Amen. Hallelujah. Tomorrow's newspaper today. You guys knew all this was coming, and here we are. Some top headlines. China's Alibaba links Quen AI app to vast consumer ecosystem. The app has surpassed 100 million monthly active users within 2 months of its release. How you doing? We covered this one. Meituan, Alibaba shares jump as China seeks to curb price wars. I love this. Alibaba stole all the share from Meituan. Now the government steps in and says, stop beating yourselves up. Alibaba's like, great, we'll just keep all the share. Let's both raise prices and it'll go straight to the bottom line. Thank you, Mr. Government. Global funds turn to China stocks, yuan, in big bets for 2026. Opinion follows trend. They now are chasing the rabbit, which we love. And in a couple of years, we're going to help them out and give them all the shares they want. Exclusive $10 billion with $10 billion in dry powder. QXO is near the next multi-billion-dollar deal. This guy works 24 hours a day, 7 days a week to make you money. He's already doubled your money in QXO. GXO, by the way, is going to be another home run. and we're super excited to be involved with both. Trump calls on Fannie and Freddie to buy $200 billion in mortgage bonds. That's helped push the mortgage rate. And some of these interest-only things are in the 4s now. If you got 10 or 20 million with a bank, they'll give you like 4% money, which is unbelievable. Trump wants cheaper housing. How Pulte could pressure builders to deliver it. Home sales in December jumped 5.1%. That's good for Generac. That's good for Stanley. That's good for QXO. Biggest gain in nearly 2 years. Generac, why the best time to own Generac stock is now. That's from Al Root over at Bloomberg, at Barron's. I know they're followers of our podcast over there. Boeing beats Airbus over order numbers for the first time this decade. How you doing, Boeing? Boeing CEO sees more work on company turnaround in 2026. We love it. Take us to the promised land, my man. Let's get our double and rock and roll. Intel stock hits its highest level in nearly 2 years. It's now approaching 2.5x, which 150% gains. It could get there. Could get there. Could it get there today? Getting close. What has the market excited? We covered some of that stuff. It's from Barron's. Diageo said to weigh options for China assets, including sale. That's going to be our next nice turnaround here, rocking and rolling. People are still drinking. They're just drinking better. Big oil and more surprising AI winners for 2026. When we played AI through Comstock and Intel and Baba, everyone thought we were crazy. They were all chasing the Mag 7, which did nothing last year. And these, Comstock is more than a triple off this when we came out on the podcast. Intel, well more than a double. And Baba off the lows a triple, off our blended basis a double. And the options were 7-baggers, which is amazing. U.S. retail sales rebound on car buying holiday sales. Can't wait to see Cooper Standard's earnings this quarter. Goldman sees consumer stocks gaining amid AI valuation worries. Late to the party as always. We love that. Online shopping, holiday shopping spending hit records. AI helped. PayPal's a player in that. Mizuho, Trump's 10% credit card rate cap could benefit fintech stocks like PayPal, like Affirm, like SoFi, like Upstart. And we're excited for that. Trump wants to run the economy hot. There's a good chance he'll succeed. Go ahead and bet against it, ladies and gentlemen. At your own peril. I mean, you're seeing what stocks are starting to run, and what he's doing exactly what he said he was going to do. Magnificent Seven stock market dominance shows sign of cracking, you think. And our article of the week: when boring wins stock market and sentiment results. We went through all of the media. Here's our update on Hormel. Each week we cover 1 or 2 stocks that we've talked about in the podcast and our own personally and for clients. While you're at hedgefundtips.com reading this beautiful article, you want to click on terms. This is all opinion, not advice. Consult your psychic before doing anything, or financial advisor or whomever. My suggestion is take personal responsibility for all your decisions, but I know that's not popular. Hormel closed out the year on solid footing, leaning into its industry-leading protein-centric portfolio to deliver the 4th straight quarter of organic sales growth, up 2% for Q4 and the full year, something very few consumer staples names can say in this environment. 2025 threw a gauntlet of headwinds at Hormel, steep commodity inflation with record high beef costs throughout the year, pork inputs up over 20%, elevated nut prices, a 5 million pound chicken recall in food service, a fire at the Skippy peanut butter facility. It was the year of Job for Hormel, and nagging avian flu impacts on turkey and chicken. All these pressures weighed heavily on margins all year and created the opportunity for us to buy stock hand over fist, and led to the bottom line results below initial expectations, with adjusted EPS coming in at 137 versus prior midpoint of 165. You haven't had this opportunity to buy this stock down off highs at this level since the great financial crisis, and that was the only opportunity you've had in the last 30 years. We got one more opportunity here, and we are taking advantage of it with this dividend aristocrat, which has increased its dividend every single year for the last 65 years. Lock in a 5% yield in a handful of years. You're at a 10% yield off your basis. And by the way, the stock has doubled, but you can't give it away. No one wants that. They want to go chase the shiny objects that are getting taken out to the woodshed right now. All right. Good news is the worst is now firmly in the rearview mirror, with 2026 shaping up to be a strong recovery year as cost savings and pricing actions flow through and the company laps many of these one-off headwinds. For the full year, management is guiding net sales of 12.2 to 12.5 billion, organic growth of 1 to 4%, adjusted operating income of 1.06 to 1.12 billion, up 4 to 10%, implying margins of 8.8%. What's even more encouraging is that this margin recovery bakes in meaningfully higher market spend, which should help deliver further top-line acceleration for the protein powerhouse. Perhaps the biggest catalyst for the recovery is the Planters turnaround. After a shaky start since the $3.35 billion acquisition in 2021, bogged down by supply disruptions and integration headaches, the brand seems to be hitting its stride and returning to growth mode. Planters delivered a strong sequential recovery throughout 2025, ending the year with sales up 12% and distribution fully recovered and up 13% year on year, setting up a long runway for growth in 2026. Despite this clear process, the market remains overly pessimistic, heavily discounting Hormel's recovery and doubting a turnaround at the 135-year-old company with leading brands spanning more than 40 categories. We're happy to take the other side of that trade. Trading at its cheapest valuation in well over a decade, combined with the higher volatility typical of midterm election years and a strong historical track record of staples outperformance in those periods, Hormel is exactly the type of high-quality compounder we want exposure to until the market comes around. We're paid handsomely to wait, with a 5.2% dividend yield, a payout that has increased for 60 straight years. We'll keep sleeping like a baby at night, holding this long-time dividend aristocrat. We highlighted the keys from the earnings call and slides. You can read them at the site. But here are your 10 key points. Number 1, Hormel delivered its fourth consecutive quarter of organic sales growth in Q4 at 2%, bringing the full year organic growth to 2%. During 2025, organic sales increased 1% in retail, 5% at the all-important high-margin food service segment, and 1% internationally. 2, Planters is fully back in growth mode, with the brand returning to double-digit growth in Q4 as dollar consumption rose 12% and volume consumption increased 6%. The distribution recovery, which had been impacted by last year's plant shutdown, is now complete, with distribution up 13% year on year. Management remains bullish on the Planters brand and expects momentum to carry into 2026, supported by stepped-up advertising and continued share gains in the growing snack nut category. 3, the Transform and Modernize initiative ended the year delivering benefits within the previously stated 100 to 150 million run rate savings, with more than 120 projects contributing value in 2025. The program was designed to generate gross savings of 2 to 3 times the cost to implement, with a payback period of less than 12 months, which has now been achieved. In addition to the T&M initiative, management conducted a comprehensive review of administrative expenses at the end of fiscal year 2025 and announced plans to reduce 225 corporate and sales roles, or 9% of the group, driving additional cost savings. You actually need salespeople to sell Planters peanuts? My goodness. It's called order takers. 4, margins remain. You could do that with an AI chatbot, AI agent, as they call it, powered by PayPal. 4, margins remained under pressure in Q4, with adjusted operating margins of 7.7%, bringing full-year margins to 8.4% compared to 9.6% last year. Profitability was weighed down by sharp increases in commodity costs, pork, turkey, beef, nuts, avian illness across the turkey supply chain, and isolated operational issues, including chicken product recall and a manufacturing facility fired, aka the Book of Job. To offset these pressures, management implemented 2 rounds, but remember, Job wound up with a lot of boon at the end of the day. He suffered through and got the payout after the fact. So to offset these pressures, management implemented 2 rounds of pricing actions across the board. A broad set of products in the summer and fall of 2025, which are beginning to flow through and are expected to support both gross and operating margin expansion in 2026. 5, Hormel announced a 1% dividend increase to 1.17 per share. $1.17 per share, marking its 60th consecutive year of uninterrupted dividend growth and its 389th straight quarterly dividend. Management paid a record $633 million in dividends during 2025, with the current yield at 5.24% and a 5-year dividend CAGR of 4%. 6. Management guided to a recovery year in 2026 with profitable growth, calling for net sales of 12.2 to 12.5 and organic sales growth of 1 to 4%. EPS is expected to be 143 to 151, representing 4 to 10% growth from this year's 137. Margins are projected to recover with adjusted operating income of 1.06 to 1.12 billion, up 4 to 10%, implying margins of 8.8. This outlook keeps Hormel within its long-term target of 2 to 3% net sales growth and 5 to 7% operating income growth. 5. Raw material cost inflation jumped more than 500 basis points in Q4, driven by the sharp increases in pork inputs, with pork bellies up 25%, pork cutout up 10%, pork trim up 20% for the full year. Management expects modest improvement across most commodity markets in the second half of 2026, though all major inputs are expected to remain above historical 5-year averages. 8. Management spent $148 million on advertising and marketing in 2025, down from $163 million the prior year, and plans a meaningful setup in 2026 to further support top-line growth. Management continues to expect margin expansion even as cost savings are reinvested into marketing while leveraging AI to boost efficiency and unlock creativity across brand marketing. In Q4, the Skippy team used generative AI to produce more than 25 high-quality, seasonally relevant pieces of content in a single day, aka Hormel is an AI beneficiary, not an AI cost center. Love that. 9. Operating cash flow totaled $323 million in Q4, bringing full-year cash flow down from operations to $845 million. Bringing full-year cash flow from operations to $845 million. Hormel's balance sheet remains sound with $617 million of cash on hand and total long-term debt, including current maturities of $2.9 billion. 10. CapEx for the full year totaled $311 million, or 2.6% of sales, with investment directed toward high-priority capacity expansions for Hormel, Fire Braised, and Applegate, as well as capital deployed at the China facility to support continued growth. For fiscal year 2026, management expects total capex of $260 to $290 million. We highlighted all the key points in the earnings call, which you can read at hedgefundtips.com. And now we're going to move on to Diageo. Similar story, ladies and gentlemen. You only had one opportunity to buy Diageo at such an extreme discount in history, off more than 50%, and that was during the great financial crisis. And if you did that, you made an 8-bagger over the next 13 years. Diageo kicked off fiscal year 2026 with a softer than hoped Q1 as the international spirits heavyweight continues navigating the post-boom alcohol reset. Organic net sales came in flat with 2.9% volume growth, largely offset by negative 2.8% price and mix. This beat the 1.3% decline feared by analysts, but failed to show early signs of sequential improvement into the back half that management had been looking for, prompting a full-year guidance cut. Organic sales are now expected to be flat to slightly down, with operating profit growth in the low to mid-single digits. The primary drag has been North America, Diageo's crown jewel market, close to 40% of sales and 50% of operating profits, where organic sales fell 2.7% and U.S. spirits dropped 4.1%. A weak consumer backdrop and the unwind of tequila's multi-year upswing, where Diageo has heavy exposure at 13% of sales, created tough comps after years of outsized performance, weighing heavily on the overall results. This weakness overshadowed real bright spots. Europe turned the corner with organic growth of 3.5%, while Guinness kept defying gravity with high single-digit gains as the fastest-growing major beer brand by volume, taking share in 50 of the last 52 weeks at a time when other beer players are taking it on the chin. Our thesis on Diageo has always been that today's headwinds are cyclical rather than structural, despite market pricing that suggests a more permanent impairment. The reality is that consumers are drinking better, not more, and no company in the space is better positioned to ride that premiumization wave than Diageo with its iconic portfolio. In the meantime, While waiting for the cycle to turn, management has been executing a classic turnaround playbook: aggressive cost savings, deleveraging the balance sheet, and prioritizing free cash flow. On that front, progress is running ahead of schedule. The Accelerate program, targeting $625 million in savings over the next 3 years, remains firmly on track, with 40% of the benefits now expected to be delivered in fiscal year 2026 alone. Free cash flow is on track for $3 billion this year, 6% free cash flow yield, with massive acceleration potential as the business inflects and underlying performance improves. Net leverage is on course to return to the targeted 2.5 to 3 times range by fiscal year 2028, with selective disposals such as recent $2.3 billion sale of the Kenyan drinks business serving as a shot in the arm for deleveraging. These are exactly the signs we want to see in an early stage turnaround. The final piece of the puzzle, and a huge catalyst, is the appointment of Sir Dave Lewis as CEO, a proven turnaround specialist with precisely the skill set Diageo has been lacking after years of mismanagement and boardroom drama. He came from Tesco and prior to that, Unilever. Lewis is no stranger to these large-scale turnarounds. Most recently, he served as CEO of Tesco, the UK's largest supermarket, where he steered the company out of a debt-fueled accounting scandal crisis. Over his 6-year tenure, he stabilized the business through selling non-core assets, aggressive cost-cutting, debt reduction, ultimately delivering structurally higher margins. Before that, he spent nearly 30 years at Unilever, earning the nickname Drastic Dave for his reputation as a rigorous cost cutter. Turnaround Tom loves Drastic Dave's philosophy of whipping these businesses into shape. In our eyes, Lewis is exactly the medicine the doctor ordered for Diageo, finally bringing an adult into the room to drive the turnaround. It's a story he knows all too well, and before he's even found the coffee machine, we're already seeing signs of the playbook in motion. With 200 plus brands and only 13 generating more than $1 billion in annual revenues against $20 billion of total sales last year, there's plenty of low-hanging fruit for strategic disposals, something Lewis is wasting no time addressing. Diageo said to weigh options for China assets, including sale. With the stock price like nobody will ever sip alcohol again, trading at just 13 times forward earnings, the cheapest level going back to the great financial crisis, it won't take much for the upside surprises as the turnaround plays out. In the meantime, investors are paid to wait with a dividend yield of 4.6%. Much like Hormel, this is another straw hat in winter, boring businesses that we think is well set up for a volatile midterm year. We buy straw hats in winter. That's the philosophy at Great Hill Capital. And we sell them in summer when everyone needs and wants them. Diageo reported the 10 key points here. Revenues of $4.9 billion, down 2.2% year on year, with headline decline driven primarily by prior portfolio disposals. On an organic basis, net sales were flat as 2.9% volume growth was largely offset by a 2.8% decline in price and mix. Regionally, strength in Europe at 3.5%, Latin America and the Caribbean at 10.9%, which was the source of their problem, by the way. They're fixing that. And Africa at 8.9% was more than offset by weaker results in North America, down 2.7%, and Asia Pacific down 7.5%. 2. The Accelerate cost savings program remains firmly on track, with management still expecting about $625 million of savings over the next 3 years to drive operating leverage and support industry-leading EBIT margins. Execution is running ahead of the plan, with 40% of the savings now expected to be realized in fiscal year 2026 versus the original assumption of a more even cadence. Early results are encouraging, particularly on the commercial side. In Great Britain, one of Diageo's most profitable markets, A&P development spend has been cut in half, and the number of agencies has been reduced by 30%. This reminds me of something Diageo, where it said here, industry-leading EBIT margins. We love to buy the highest quality asset in the most dislocated, hated sector, whether it was ExxonMobil in 2020 when oil went negative at $33, or Wells Fargo at $25.10 during COVID, or Vornado in the low teens when you couldn't give away an office building a few years ago. Their buildings were the highest quality in New York City. Or Diageo in the alcohol. You can't give away an alcohol stock, and it's the highest quality one. Over and over, rinse and repeat, the highest quality assets in the most dislocated sectors. And in China, it was a simple decision. Alibaba is the highest quality asset in China. When no one would buy China, we were buying Alibaba hand over fist. Why? Because they were generating $25 billion of free cash flow. They had $80 billion on the balance sheet, and you couldn't give it away. And now people are just waking up to the fact, and Goldman's getting excited. So 3, free cash flow is expected to come in around $3 billion fiscal year 2026, 6% free cash flow yield, up from $2.75 billion in fiscal year 2025, with further annual growth and underlying performance improves. Fiscal year 2023 marked a clear inflection point for free cash flow, and a return to the $4 billion range is back on the radar as management maintains discipline around A&P spend, CapEx, and continues to deliver on the Accelerate cost savings program. What's the common theme here? They're generating massive free cash flow. We love that in a turnaround. 4, Guinness continues to be a bright spot, posting 9% growth in the U.S. and significantly outperforming the beer category. That zero thing is super, super popular, taking share of 50 of the past 52 weeks. Management still sees plenty of runway to scale the business and expand capacity, with the brand's 3-year CAGR now in the strong double digits, and Guinness Drought 0.0 and RTDs all maintaining strong momentum. 5, we've been pounding the table on the theme of multinationals benefiting from a weaker dollar environment, and Diageo is a clear example of that, with 60% of sales generated outside of North America. The company is seeing a meaningful FX tailwind, with management expecting $200 million boost to net revenue and a $50 million lift to operating profit in fiscal year 2026. How you doing? Management expectations around tariffs remain unchanged, with an annualized impact of about $200 million before mitigation. Diageo expects to offset roughly half of that impact on operating profits through mitigation efforts before considering any broad or tariff-specific pricing actions. 7, U.S. organic spirits organic sales declined 4.1%, driven largely by softness in tequila. The tequila category, which accounts for 13% of Diageo sales, is coming off several years of outsized growth at 10% in 2023, 6% in 2024, now slowed to 3% in 2023, with Diageo's significant outperformance over those years, creating tough comps. To offset the weakness, management is leaning into RTDs to re-engage consumers and reinforce the brand halo, with Casamigos RTD launch off to a strong start. 8, management updated full-year guidance to reflect pressure from Chinese white spirits and a weaker U.S. consumer than originally expected. Organic net sales growth is now guided to be flat to slightly down versus prior expectations of fiscal year 2025 growth of plus 1.7. Management still expects positive operating leverage, with organic operating profit growth now guided to the low to mid-single digit range versus the prior mid-single digit outlook. 9, CapEx for the full year is now expected to come in at the low end of the 1.2 to 1.3 billion range, down from about 1.5 billion in fiscal year 2025. The lower spend comes as management continues to emphasize cost discipline and a focus on maintaining strong double-digit returns on invested capital. Amen, hallelujah. The holy grail right there, while still seeing meaningful opportunity for further improvement. And 10, management remains committed to returning to well within target leverage range of 2.5 times to 3 times net debt to EBITDA by no later than fiscal year 2028, supported by appropriate and selective disposals over the coming years. That's key in turnarounds, is having lots of outs. For those of you who play poker, we played the same playbook with VF Corp, which is now starting to hum, and early days. Market neutral to greedy, getting a little bit frothy out there. National Association of Active Investment Managers, a little bit off the boil. We have officially closed out our opening to smaller accounts, the $1 million accounts. We open once a quarter. Congratulations on everyone who made it in. Congratulations to all the existing clients who upsized their contributions, some hitting new levels and got better deals because they added a lot of money to their accounts. And we want to thank new clients who joined us during the opening, along with our existing clients who upsided. The larger accounts, the $5 to $10 million plus accounts, you can come in anytime you want and can access that service at hedgefundtips.com. Just fill out the form under money management, not a solicitation. Talk to whoever you are supposed to talk to, whatever. But we'll be happy to talk to you and see if it's a fit. All right. NASDAQ top 30 weights, earnings estimates and revisions revised up 3.27%. That's the top 30 weights in the last 60 days. Dow was modestly revised down by 63 basis points. Economic data has been good. The jobs data was actually pretty strong today, with continuing claims coming in lower than expected and initial jobless claims lower than expected. Earnings growth expectations continue to go up from 305 to 310. So that's constructive for the time being. 357 next year. That's a big deal. And now we're going to move on to our Ask Me Anything questions from the audience. Very exciting week for that. Question 1 comes from Ryan Rowland. Thoughts on Star Surgical? Activist board just cleaned house, owns 30% of the company after they blocked a sale to Alcon, STAA. Let's take a look. Ryan kind of checks the box here in terms of healthcare and catalyst for change. All right. Still free cash flow negative. I don't love that. Let's look at it on a quarterly basis. Yeah, no sign of a turnaround there, or in margins, or in revenues. But it's priced in probably a lot of bad news, so it can't be all bad. Let's take a look at the financials. For me, it's a wait and see. Let's start to see them turn the corner a little bit. But balance sheet is looking... we might have to just make this a little smaller so we can fit it here. That'll work. All right, there we go. 230 million of cash, 80 million of receivables. Not much debt. Let's take a look at the cash flow. Still negative. Oh, did they hit a quarter of positive free cash flow? Okay, that's good. I'm sorry, not free. Where is it? Free cash flow. Yeah, so they had a quarter of positive free cash flow. That's good to see. Balance sheet looks okay. Income statement. Yeah. Stock-based compensation is a little bit piggy here. The activists should clean that up. What do they do? Implantable lenses for the eye. Lens product family. Laser-based procedures such as LASIK. Myopia, products of healthcare, vision surgical centers. I mean, the only problem with this business is after you fix people's eyes, they're fixed. That said, I think you're probably okay here, but I think there are higher and better uses of your capital. So I think it's okay. I think it's going to take a longer to turn than you think, but I think you'll probably be okay. Jake, Primac, Prop. People giving me the low quality energy names. Let's take a look. I'm seeing that one a lot. Prairie Operating Co. Free cash flow is still negative. Let's take a look at the balance sheet. 5 million of cash, 12 million of receivables, 32 million of debt, long-term debt. What's this current? Oh. Free cash flow keeps getting worse and worse. Huge increase in the share count. This is just a dog shit company, but it's probably going to bounce a lot because it's a promote. And it depends who controls the stock. But if they don't go bankrupt, you're probably going to make a 10-bagger. So treat it, if you need to be involved in that type of game, reindeer games, then just price it like weight it like an option to manage your risk, 1 or 2% of equity position. So if it goes to zero, it doesn't, you're not applying for jobs as a Walmart greeter, and they don't take you out on a stretcher. And if it doesn't go bankrupt, you'll probably make 10 bags. So that 2% becomes 20% of contribution. There's definitely asymmetry in there, but it's gambling, not investing. And for that reason, we're out. John Sismadia, what do you think about copper in the 2026 future time frame? I don't really give a shit, to be honest with you, what the price of that does. Because I'm bullish on the economy, it's going up, but I would prefer to just focus on individual companies. Dr. Copper is kind of a barometer of this, but I mean, if you're chasing copper up here, you deserve to lose your money, even if it goes higher. So pass on that. Nikolai Jensen, thanks for a great podcast. Can you look at Dava? We've looked at Dava a million times. It's software. We're not comfortable with determining whether the moat is temporary or permanent, which is why we tend to avoid software if you followed us for some time. So we've been getting a question on Dava for 2 years, and we've continued to say pass. And if you're going to be involved, you better damn well know what the moat is, and it's since dropped from 30 to 6. So, maybe at 6 now it's a good buy, but we've been getting questions since $30 and we've continued to say no. So, I mean, with something like this, your number one thing is just making sure it's not going bankrupt. And based on the balance sheet, I would say with reasonable confidence, it's not going bankrupt. I mean, this is tough because I think it's going to work for you. Technology services, digital product acceleration services, blah, 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 digital strategy services, enterprise architecture, data strategy, delivery services. I mean, it's just a bunch of words. It's unclear what the hell they even do. Oh, they put artificial intelligence. Ugh. Emerging technologies, we've developed an AI native approach to digital transformation. I mean, it sounds like from payments to finance to healthcare, real value. Seems like a consulting business that could be disintermediated by AI. Managed services, managed cloud, blah, blah, blah. It looks like they just come up with every catchword we could possibly put in our description to hopefully get someone to buy our stock. I think this is a similar story to the one that I just mentioned. I don't think it's going bankrupt. Therefore, your downside's probably protected. It could go to 1 before it goes to 20, but I don't like the business, so I'm not going to be involved. But as far as what the price is going to do over the next 3 years, I think you got decent odds that it'll be higher. Might go lower before it's higher. Rick Richard sends in BLDR. Let's take a look. I mean, this is up. It was a 214 bagger. Now it's fallen 15%. I think you kind of missed this one to be chasing up here. Yeah, it's pulled back, so maybe you get a double as it retraces. But let me just see if gross margins, free cash flows down a lot. 3.7 billion dollars of debt, 150 million dollars of cash, and 1.6 billion of receivables. Free cash flow is solid. It's halved, but it's solid. Revenues have been falling since 2022. That makes sense. They brought the share count down quite a bit. Stock-based compensation a little bit piggy. I just think there are way better uses of capital in the home building play. I think you're probably right. It's probably bottomed and going back up, but I mean, why wouldn't you want to play like, I mean, I know Stanley's moved up a lot, but Stanley or QXO's already moved a lot. That's probably going to consolidate for a little while. Generac, it's okay, Rick, but it's not highest and best use. I mean, maybe you get a double over a few years, but I think there are better uses in the group. But I think it works for you. It's just you got to determine, is it highest and best used. York Bourgeois, blah blah blah. Bank earnings, they're fine. Are they poised? Are banks poised for a big run? No, you missed that. XLF, no. I mean, are you kidding me? Maybe regional banks. Regional banks look like they want to break out, but I wouldn't be chasing either of those. You want to buy what's down, not what's already up. Bill Carr, Best Buy. Best Buy is the perennial value trap. There's no catalyst. It's just cheap, decent compounder of capital, decent niche. Not interested. It's where money goes to die. Tim D. Duolingo, we've covered that a million times. Great business, but it could be completely disintermediated by AI. You could have any chatbot come up with a similar course for free. I think it's probably the best thing out there, but not for me. Jessica Weldon. And by the way, we got that question at $300. We got it at $250. We got it at $200. We've been saying the same thing, pass. And it's now down to $150. Jessica Weldon, Medline, MDLN. We tend to avoid any company that hasn't been reporting for more than 5 years. So this is not for us. Frantisek Talafa. Great work, blah, blah, blah. Watches of Switzerland Group. Ugh. This reminds me of all the people asking me about Fossil, which was a complete disaster. WOSG. Watches of Switzerland Group. Sale of fashion and classic watches. International retailer of watches. Huh. Why did it fall so much? That's the question. It's a nice Patek right there. What the hell happened to this thing? Oh, maybe they issued a lot of stock. Let's take a look. $37 million of cash. $257 million of debt. That's not bad. Free cash flow is positive. Sheet, income statement. I do not understand why this thing is down so much. Unless this chart is wrong. Let's take a look. Ah, chart's wrong, I think. All right, $15 down to 5. Not. Yeah, okay. All right, so it's down 60% off of its high. 11 times. Seems EBITDA. I mean, it's not a great business generally, but I just don't see what the growth drivers are. And with that amount of cash, why aren't they buying in more stock? I think it's okay. I don't think it's a super great use of cash, but I think it's, let's see, they've been around since 1924. Majority of its sales come from Rolex. US market, second largest player in the industry. Branded jewelry from Prague. Yeah, I think you're okay there. It's not for us, but I think you're okay. Nice find. Batu Uslu STM for someone who missed Intel. This is lower quality stuff. I don't like to play here, but let's see. Still negative free cash flow. Still right. It's not for us. I'm gonna pass on that one. Next, Bob Atkins. I gotta get through these. Thanks for all the great content. ConMed. I think we covered this last week, and we were kind of okay with it. Yeah, it's fine. Matt Mahler, Cal Marine Foods. It's fine, but no, it's not fine. Not for me. You're late. Next, Matthias Mool, Pandora AS. Jewelry. Why do you guys all want this jewelry stuff? I just, yeah, I don't know. So you got $1 billion of debt. All right, that's fine. Cash flow. Good. Good. Fine. I think you're okay. Not bad. Good find. Job, Matthias. Devis Lung. There's been a high-profile class action consolidation against PayPal over its Honey browser extension. How significant an impact do you think this could have on PayPal? 0. We bought a ton of stock today. James Sharp. Duolingo, same thing. Pass. Chris Williamson. Pump, same story. Don't buy the, or price it like an option if you want to play that game. UPS, not for us. We don't like the CEO, but it's recovering in spite of her. Andrew Fit. Okay, that's for becoming client. You're all set. Tim D. Hims. No, they're just a middleman. They'll eventually get squeezed out. Next. Piet, Bass, TTF. Yeah, it's not coming up here. You're saying it's on the Swiss exchange. The only one I'm seeing is Chinese. We don't buy any Chinese stocks unless they're named Alibaba. So get me a ticker. Andrew, Robert S. Kudos for all your work educating us neophytes. The vagaries of investing. Your opinions are of great value. Tempest AI. Would you accept a group of individuals that are willing to pull their resources? We can't do that. You have to be qualified individually with a net worth greater than 2.2 million outside your personal residence. I don't make the rules. I just follow them. But thank you for your interest. Tempest is negative free cash flow. No, this is not for us. By the way, welcome to the podcast. Operates as a healthcare company. Yeah, it's still negative free cash flow. We're going to pass on that. Moving along. Brent. No, we got Greg already. Brandon. Oscar. We've covered this one a million times. This is Kushner's brother's thing. This is outside the scope of what we do. But the numbers look pretty good, but we're not going to be involved in that. Next. Eric F. Greg Bennett. He's asking about mistakes. I mean, the only thing that we don't really have mistakes. It's just sometimes things take longer than we think that they will. I mean, our underwriting framework, Buffett, I was watching an interview with Buffett. He's like, if you do this right, you really can't lose money. And that's the case. It's like low margin, good quality businesses at good prices. Your only mistakes is if the IRR is eroded because it took 5 years instead of 3 years, but that's offset by the ones like Albemarle that take 10 months instead of 3 years. So if you have a basket of 8 to 12 and you do the underwriting properly and you live your days to say no to investments versus trying to do confirmation bias and looking for reasons to buy something because the price is doing a certain thing, it's very hard to make big mistakes. It's not to say we won't, and which is why you always want to have 8 to 12. So for those of you listening and you hear one idea and you get confirmation bias because you've been looking at the same name and you put 30, 40, 50% of your portfolio, you deserve to lose 30 to 40 to 50% because usually it's right after a win. You get hot hand fallacy and you say, oh my God, I just made 3x on Albemarle, and then the next name comes up. And so if I just put 100 50% into this one, I'd make 20x, and that one's the one that goes to zero. So, you know, if you don't risk management, you'll get taken out on a stretcher. Eventually, you'll make a mistake that'll wipe you out. But if you stay in the framework and you balance it with 8 to 12 great positions, even if one fails, the others are doubles or triples, you're still going to outperform the S&P. So it's all risk management after you have a sound framework. Okay. Got that guy in. Daniel Jones, FMC. We covered this last week. I think it'll work. It's not without bankruptcy risk, so you got to price it like an option. So I would just say, rather than it being a 10% high conviction position, 2 or 3% if it goes to zero. It's not life changing, but if it works, which it probably will, you make 4 to 8 bags, and on 3%, that adds 24% performance. So you got to just position it like an option. There's a little balance sheet risk, but I think it's going to be a big winner. Okta, that comes from Luca, who plays for the Lakers. Now, it's not that Luca. Well, maybe it is. Let's take a look at Okta. This, again, you have to understand technologies, but on just a numbers basis. I mean, the key thing with these technologies is you have to figure out what's their moat. Can they get competed away? So probably going to imagine secure identities, sign one, security. I mean, yeah, if you can be damn sure it's not a me too, the numbers look fine. But I don't think you can be damn sure that they're not going to get competed away, which is why we tend to avoid technology, just as we learned from the master Buffett himself. But if you have some edge and you say, oh, this can never be replicated, then yeah, it's a good time to buy it and a good price, but not for us. Huntsman, I generally think you're okay here. This is run by good family that knows what they're doing. You're catching the cycle recovery. I think it's fine. Nice find. Matt in North Carolina asks about, deeply appreciative. Thank you. Glad to hear that. What is... Oh, he's asking, should you buy on margin when things fall a lot? We never go above 10 to 15% margin. So sometimes if you get those big dislocations like April, some of your defensive stuff will hold up. You can sell that to create opportunity for those things that are down a lot to increase the size of your position that have better IRR prospectively. But no, we never really go over 10 to 15% margin. So but usually going into things like that, we've raised some cash because the market's a little frothy and we have the benefit of that. And then the additional 10%. So on those opportunities, we can buy a lot of stock very, very quickly. Or we can use options where we can magnify 2-3%. Notionally gives us like 10% new exposure at very low levels. And if there's spreads, you're not at the effect of the high implied volatility because you're offsetting it by selling against. Perigo, we cover that. This is where money goes to die. It's a generic drug company. I mean, at these levels, you probably don't get hurt. Teva recovered, but they have some unique stuff. I think at this level, look, the financials are fine. It's just dead money, but maybe you get a double out of it and collect a dividend along the way. Not for us. That's Don. He's come in. Matthew Wortley. Baker Hughes, yeah, I mean, oil servicers, we like Varco better, but you're late to this. So wait, yeah, you're too late. Buy National Oilwell Varco. Daryl Muscle, love the podcast, learned a lot, blah, blah, blah. How long will you give a company to start meeting your financial criteria? They usually are already meeting it by the time I buy it. It's just the price is dislocated. So we don't care. Over 8 to 12 companies, some double and triple in 12 to 24 months. Some take 36 to 48 months. But on average, we get our doubles or triples in 3 years. And that's what we need to make the magic happen. Christopher Hillett between the options, which get multi-bags, and the stock that gets doubles and triples. MREIT, I don't mess with these. Mortgage REITs, you have no idea what you own. Skip on that. Next. Don Frank, we got that. Jorge Nino, beginning a new role on the sell side as research associate. On the buy side, what do you wish sell side did better? Nothing. I don't pay attention to the sell side. What changes do you wish to see? None. Keep doing what you're doing. You help me get into stock at the lows because you always downgrade in the hole, and you help me get out of stock at the highs because you guys are upgrading it till the cows come home. So keep doing what you're doing. That's how we make money from your help. How did I come up with the name Great Hill Capital? Asked Joe Cook. Like every creative hedge fund manager, I named it after the street that my house was on in Connecticut, which was Great Hill Road. So we named it Great Hill Capital. Genius. Noah L, love the podcast. Share it with friends. Thank you very much. Just wondering what you would do if a client already had 8 to 12 stocks, added more money to the account. It would probably go to the laggards, the ones that are still cheap. It wouldn't chase the ones that are already up a lot. Don, I mean, it's a complex question. It's situational. Chris Peterson. Okay, these are all the clients that came in. Jason, CLVT, Jason Greenblatt. What do these guys do? They're trading like death. Information services provider. Again, this is software. Stay away. I mean, you probably get a trade out of it. Dwayne Ramelat. Mondelez. Better, higher and better uses. Alejandro Bustamante, Coupang, CPNG, the Amazon of Korea. If I remember, it just went out too expensive at the IPO. $58 times earnings, enterprise value to EBITDA. It's okay. The problem is it's a great business in a low growth market. So for that reason, I'd pass. Michael's a new client, and so is Chris. All right, with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Thanks for tuning in. Bye for now.